Hi, and welcome back again to Tim Bigham's Options and Volatility newsletter. Taking a look today at an unusual option activity-based covered call idea on OSCR Health, where big repeat call buying lifts the IV to basically the highest levels we've seen over the past year, and a way to capture that rich option premium and follow that call buying by buying the stock and selling these very expensive calls ahead. So let's jump in and take a look. First of all, here's the option scanner, one of them I use. You can see OSCR Health hit up yet again on Friday, over 130,000 almost contracts traded, which is more than 4 times the average volume. You can see that the IV level now at the 88th percentile, certainly getting expensive. And IV did jump on Friday as well, now residing at nearly the highest level we have seen. Taking a look at the chart, you can see the stock did rip higher. Right here's where a lot of that UOA came out, right? Anyone who bought calls up here paying a big price for it indeed, right? You can see it's also approaching the highest levels over the past year. So I simply went back to the last time the stock traded at 1647 or so, and actually found today where it closed exactly the same price going back a few months. We'll do the comparative here in a second, but you can see the technicals have now gotten to fairly neutral. RSI mid-range at 40. MACD actually with a short-term sell signal, right? Bollinger %B, which had gotten to extremes here, right? Now back to a more muted level. But most importantly, again, IV, you can see now at the highest level outside of this quick spike back here, which was quickly met with a big reversion, right? And that was based more on earnings. So certainly implied volatility jumping here because of that big repeat call buying. So I simply took a look going back from then to now. So did the comparative. Here it is now on Friday, July 4th, right? Stock closed at 1647. The $20 call, right? The September 20 call closed at $2.15, right? 210 bid, offered at 220. So that buy right, buying the stock at 1647, selling that call would equate to about 1432. So you have $2 plus of downside protection, but still leave yourself basically 3.5 points of upside participation, or about 20%. More importantly, the IV now at over 108. Certainly a big jump from where it was before, as we'll see in a second, and that equates again to that big jump in implied volatility here as continued repeat call buying certainly drove implied volatility to extremes as well. And you can see days to expiration now, I chose a 77-day expiration. That's somewhere around 60 to 75 to 80 is where most people like to play their covered calls. You get enough premium and leave yourself enough upside cushion. In this case, as we said, 20% upside cushion, but getting well over 10% downside protection. The delta on the option, interesting, is 45. We'll take a look at it versus when the stock was last here and how the implied volatility lift brings the delta actually higher. So let's take a look at the last time that the stock was here, and we'll go back to May the 21st, right? You can see the stock was at 1647, right? Exact same price as today, so no change on the stock. Yet the $20 call, right, was at $1.12, 105 bid offered at 120, right? Which means that buy right 1534 back then, right, with the stock at 1647, now 1432. So because the call's up basically a little bit over $1, the buy right is cheaper by $1. And more importantly, days to expiration back then, the comparative 86 days, now 77. So you have 9 days less until expiration. Time should make the calls more expensive, but because the IV jumped huge to over 108 from under 70 before, right? A jump of almost 40 vol points. You can see that that call price, even though it's shorter term, right, with the stock at exactly the same price, has gotten more expensive, basically doubled in price from a little bit over $1 to a little bit over $2, which makes that buy right much, much cheaper, right? So you're able to follow the flow, lean bullishly, right, by buying the stock with 100 delta and selling that call option, which now has a 45 delta, as we said. Last time it was at this price in late May, the delta on that option, the same option, 35, right? IV rising brings all deltas towards the absolute value of 0.50. So in essence, right, you're getting more delta protection. In reality, right, you're getting kind of more protection simply because you're able to sell the call at twice the price, right, have a bigger downside cushion, still leave yourself plenty of upside, and have less days to expiration. So anytime to me you can sell a call that has less time till expiration with the stock at the same price, right, for double the price you could before makes a lot of sense to me. So it's a way to follow that flow in a bullish manner. So basically a little more than 50 deltas net long. Buying the call would be just under 50 deltas, but you're able to sell these very expensive options, as we said, IV at the most extreme level outside of a brief period here in front of earnings that we've seen over the past year. So that's how we go about identifying potential trade ideas with a probabilistic edge. So until next time, as always, here's the good trading. Take care.